been a good month out there in the market, so welcome to my monthly stock portfolio update. So as the reference point last month, I was at 39,753 for the portfolio, and the portfolio has now moved up past 40 again, 41,344, so very happy with that movement within a month. It's a good movement month to month, but it's within a normal variability range. As Terry Smith says, even a year is too short a period to measure portfolio performance. It's just an arbitrary time that the Earth goes around the sun. It's got nothing to do with how well companies perform. With that in mind, I have the longer term context here. My original £1 million portfolio challenge, a very long term challenge, was to add £300 a month into a starting amount and get there by 2060. I've actually put a bit of a stretch target on myself, so probably want to get there by 2050. But to get there by 2050, by the end of this year, I'd need to be at 38,536 for the portfolio. And as you see, I'm a bit above that at 41,344. And since last month, the performance of the portfolio has returned an additional £1,300 or so, as well as a £300 monthly deposit in line with the minimum amount. If you found the same sort of thing with your portfolios, if any of you have stock portfolios, do share below how you've done in the last month. Be interested to see how you guys are doing. The key thing for me is how much does my portfolio need to grow at what annualized rate in order to hit those targets that I've mentioned. And this is something that I don't really see many other YouTubers doing. So I want to make it nice and clear for you, and actually it will help me as well. So I need to hit it by 2050, which is ideally the latest when I want to do this. So the stretch target, I need to make 9.45% a year on an annualized basis, assuming I'd keep putting the minimum of £300 a month in from today. Now, I would hope to put more in than that if I underspend on my budget in a particular year. But let's look at sort of the worst case scenario. So 9.45%, that feels like it could be an achievable amount. And certainly the 6.39% for the original slower growth, that should be very achievable. So let's move perhaps into the month-to-month change in the portfolio. The orange line, or the light colour line on your screen, is the portfolio on an indexed basis against the FTSE 100, my main domestic index. So that's done better than the index in last month. And I thought I'd actually change the format of the information to make it a bit more engaging for you. So I'm going to show you the dividends that have come in August. And some very good dividends there, particularly from Investec and Unum Group, which are two long-term holds that I bought when they were a long way below book value. 4 sells this month. I don't want to be this active usually. 3 of these positions, the bottom 3 on the list, I've closed out of completely. I was overexposed to China, and so I've sold out the China index. I've already got decent positions in Huya and Alibaba in particular. I wanted to reduce my exposure to China just from a risk management perspective. Sandwich's growth properties have been on my sell list for a long time. I think my average was around about $14 or so for the stock. It had been about $5 just a couple of months ago, so it was looking quite bad. But it absolutely run up really quickly, and I managed to get out of it with exactly a £1 profit. So I'm very happy to be out of that position. Gone. And then the Asian Income Fund is very, very similar, almost overlapping with the Asia Pacific Index I've got with higher charges. So again, I've dropped that one out, even though it had an 80% total return on it. Sold a very small percentage there in AMR, my Alpha Metallurgical Resources, a coal miner. Coal was getting to sort of 10% of my portfolio. There's quite a lot to having a cyclical commodity that I will need to sell at some point. So therefore, I've just trimmed that position. And if that stock price keeps running up even further, I will just start eating into that position. But not too quickly, because the conditions for that still, there's a lot of metallurgical coal being bought for thermal purposes due to the energy crisis at the moment. Buys, 2 brand new buys. Having read Terry Smith's book several times, and thank you to one of my viewers who recommended that to me, I think towards the end of last year. Brilliant book. If you're interested, there's a link in the description there to take you straight to that. Check it out. Really changed for me how I want to manage my portfolio. Absolutely fantastic. So I've entered an introductory position into the Fundsmith Equity Fund. It's only a small position to start with, but I'm going to be adding to that each month. And I want to grow that out into one of my larger positions. As an individual company, I purchased Somero Enterprises as a kind of a long-term compounder. They could work in construction with some good machinery to help with the screed and that kind of thing. and then very high return on capital rates, very high margins, and as a bit of a bonus, they also pay a dividend as well. Now, how I've organised my portfolio previously, I've kind of done a bit of a grind. I've gotten through one by one in terms of the Asia Pacific, US, UK portfolio. I wanted to just make it a bit shorter and a bit more useful to me as well as you in terms of how the portfolio is shown and measured. And after really trying to pick up from Terry Smith in that book, I've really been thinking about this. I'm no longer splitting my portfolio on a geographical basis, nor am I splitting on how I used to have it, which was growth, value, dividend, and then a few different fund types. Growth and value ditch, because actually that's not how I want to be operating going forward. I want my portfolio to be a portion of what I call managed by someone else. So that may be index trackers and a very small number of funds. So, example, Terry Smith's fund. That is my protection against me absolutely ballsing it up. So if I'm not very good and I perform poorly, the backstop there to stop me going too far down. So yes, it will draw me up towards the average return, but equally, of course, if I'm doing really, really well, it will drop me down a bit. But it's all about risk management in terms of making sure I don't lose. So that's why I've got that amount. I'll probably aim for up to a quarter of my portfolio in that. I'll still have the cyclicals. I won't have a target for that because it only be as and when some very special situations are identified, such as the coal at the moment, where roughly 10% of my portfolio is, or just under that. Then I have the core of the portfolio, and it's really showing me I don't have enough companies in this sector, sort of the high quality compounders, companies with very high return on capital rates, high margins, that are very high quality companies that will be around for a long time. So Berkshire Hathaway being a great example of that. I don't have enough of those companies, but I want to start focusing my new purchases, if I do have any, in that space. I'll still have the dividend part as a small part of the portfolio, but not buying for dividend yield, but buying where the companies are undervalued. So, for example, high quality insurance companies like Aviva, I bought them quite a bit under book value. So there's a little bit of capital appreciation to go with the dividends. So that's the only time I want to be buying dividend stocks now. And I have got then some positions where I either want to sell them or I can't really categorize them. I can't really categorize them into cyclical, dividend, high quality, or managed, then I probably shouldn't be owning them. Actually, that's how I want to think of it going forward. And actually, the results are quite telling breaking it down this way. And it's really helped me to think about how I'm managing this portfolio. I hope that's been useful for you, and I'd love to hear what you think about that below. So to start with the cyclicals, we've got the alphabetical electrical resources at the top, over £2,500 coal stock there, and that's done 400% in total for me across the various tranches on that one. Now the stock has run up in the last month. That change in month is artificially high because I sold some position in one broker which had a higher average cost, so the remaining average cost is lower. Ramaco Resources, my second biggest cyclical, also coal company. I did trim half that position in July, which is in that update, and yeah, that's stayed roughly level, about 200%. And then the rest of the cyclicals are quite small positions. Now, my portfolio updates before, I broke it down into geographical areas. I had a few £100 in rest of the world and crypto, which you would see from some older videos. I'm including those in the cyclical here, these crypto ETFs. Now, very, very small positions. If the crypto did 10x, it would still do something. They are down quite a bit as crypto is. Turtle Beach is in the cyclicals. I'm really considering whether to sell that one. Now move on to the dividend performance. So the values there, Unum is the biggest. That's up over 100% in total now, 2%. Up 36 points in the last month. Had a really good month in August. Aviva, my second biggest. I've talked about Aviva a lot on this channel. It's been quite positive in the last month, and I think they're paying out a dividend in September, so watch out for that, Aviva shareholders. And the only other ones to flag was on this list, we've got Investec doing well there at 205%. That has dropped off a bit in the last month. Other than that, these are sort of companies, most of these I'm just going to hold, got good dividends, so unless they have a material deterioration, I'm going to continue holding them on the basis of the dividend. The exception might be the bottom two in the list, because 91 was a spin-off from Investec. Such a small position, it's always pointless. And again, Sturm Ruger, it's a very, very small position. So is there any value in holding that? So I may well take those two out just to simplify the portfolio. The rest of them I plan to hold. Although edit, having said that, Direct Line's another one I'm looking at because I don't think Direct Line's as good as Aviva or Legal in general. So I may take out Direct Line as well. Right, that's the dividend bit. So these are the companies, the quality, sort of the long-term, high margin or high return on capital companies, great management teams. These are the companies that the sort of the hold for 10, 20 years plus potentially, really long-term holds. And it's more about getting them and not overpaying, and then they'll compound very quickly. Banknotes UK, as it has been for a while, one of my favourite holdings, that is up 84%. Other ones to flag as a good bump, you've got Kelly Partners Group, Australian company, 14 points up. Let me know if you've come across that one. It's quite an unusual one, but interesting management, got long-term compounding potential in my opinion. The only one I'm particularly sort of unhappy with at the moment is Intel. Not necessarily because of the share price performance, but the amount of capex they're going to have to spend in the next few years. I mean, their free cash flow is going to be low. They're not going to make those returns on invested capital, but maybe 4 or 5 years' time, they should be. So it's whether or not I want to wait for that. But what strikes me here for my portfolio is split them out this way. The value in this pot compared to the total portfolio, it's not high enough. There needs to be more high quality companies or more money in these high quality companies. So here's the sort of protection against my own ignorance, the managed part where others manage my money, mainly indexes, but a couple of managed funds. FTSE 100 index, the largest position there. That sort of ticks along very quietly in the background. And then there's a few funds here that are around about 100% in positions 2 and 3. The UK smaller companies, one they're taking quite a hit in the last month. I think the smaller companies are struggling in this cost of living situation. Yeah, you can see towards the bottom there, the Fundsmith one, and that's going to be bumping up that list over the course of the next 12 months for sure. And that very bottom fund there, I'm probably going to sell out of that one because again, it's too small to make any difference. But let's just simplify it. But so do you guys have many index funds, or are you totally against them and you trust your own investing style to outperform? Love to hear your thoughts below. These are the ones that I couldn't really categorize into any of the boxes that we've seen so far, which makes me think, should I really be owning them? Now, Alibaba's still a good company. It doesn't have that really, really high return on capital rates. It's still a good company, big position. It's down about 29%, but in month it's still better than it was. Corsair has very low returns on capitals and margins, but it is the leader in its field. It's a very high quality company in terms of the products it makes, and I've used many of their products. Maybe it's given me a bias and I shouldn't have bought them. I'm down about a third on that. It has done well in the last month. Boohoo actually has had some decent return on invested capital rates previously, though that's dropped off now. I think they'll suffer in the next year with the cost of living situation. Cumulus was bought as a turnaround, so it doesn't really fit in those boxes that we've described. I think there is a good management team there. But the bottom two are more sort of growth stocks. And actually, a lot of the ones on this list, well, Corsair and Boohoo were growth stocks. But I don't really buy growth stocks anymore. I want to be buying the combined growth value in terms of the quality companies where they're compounding with high return on invested capital rates and high margins. So I don't want the old traditional growth stocks. I'm not very good at picking them in terms of my entry points. And you can see from the performance on these, they're much worse than all of the other positions. And last and probably least, 3 that I want to get rid of. Well, Voyager's essentially dead anyway. Gannon Huya is a decent company, but I've put too much into that and it doesn't fit in any of these boxes. I'm happy to get rid of it. It's just that question, do I wait until it goes back so I don't lose as much money, or do I just take the hit now? I mean, the stock doesn't know that I own it, and if I don't want it, I should probably sell it. It's quite hard to sell on a 55% loss, so I just need to really think about that. Do any of you guys don't know own Huya? Let me know what you think about it. Thank you. So that's what I've been up to this month. Check out the video link that's coming on screen now. This side or this side, I think. That link will be 2 stocks that I was thinking about adding to the portfolio and almost did, but actually I didn't buy them in the end. And check out the video to understand why.